Welcome to the show. Picture this. Brent crude pushes above $100 a barrel at the exact moment Morocco lands a $1.2 billion sovereign AI infrastructure deal. That is Africa's business story in one frame right now. One part geopolitical shock, one part capital voting for stability. And the shock is not abstract. If the Strait of Hormuz is blocked, even temporarily, energy markets don't politely wait for clarity. They panic first. Prices jump first. Shipping risk premiums jump first. For African economies that import oil, that means the pain arrives before any government can draft a response. It hits fuel costs, transport, food prices, and then, very quickly, the fiscal math. So when Brent goes above $100, net oil importing countries are suddenly staring at a nastier bill for energy and, usually, for inflation control too. You pay more to import fuel, more to move goods, and often more to protect households from the fallout. That is a brutal combination if your budget is already tight. It sounds technical until you think about what it really means. Treasury officials trying to hold a line while every truck, generator, and supply chain in the economy gets more expensive. South Africa is a useful, concrete case here, especially around diesel risk. If global supply is stressed, diesel becomes more than just another fuel line on a spreadsheet. Diesel keeps logistics moving. Diesel supports backup power. Diesel matters to mining, agriculture, freight, the everyday machinery of business confidence. So even before you get to headline inflation, you get this quieter anxiety in the real economy. Can companies keep operating smoothly if fuel markets turn messy? And then, right alongside that, Morocco. Morocco says, here is a country that global capital increasingly reads as predictable. The sovereign AI infrastructure deal is worth $1.2 billion. The project is built around 36 megawatts and, crucially, powered by 100% renewable energy. That detail matters. In a world worried about energy insecurity, Morocco is not just selling data capacity, it is selling reliability. I was going to say it's just an AI story, but actually, the more interesting thing is that it's a location story. Investors are looking at Morocco's political stability, its access to Europe, its industrial positioning, and its ability to host advanced infrastructure without a constant question mark hanging over power or policy. That's what the money is rewarding. And I have to admit, when I see a 36 megawatt renewable-powered AI build-out on one side and a Hormuz-linked oil shock on the other, I feel that contrast very personally as an observer of African markets. Because this is what investors feel too. Fear is getting more expensive, but predictability is becoming premium priced. Not cheap, premium priced. So the signal is not that risk has scared capital away from Africa. Not exactly. It's that risk is sorting the map faster. Energy stress punishes importers immediately, while stable, strategically placed markets can still pull in advanced tech money even in the middle of global turmoil. Same continent, same week. Two very different cost of capital stories. And that is why, in Washington, at the IMF and World Bank spring meetings, the real conversations will almost certainly be sharper than the official communiques. The public language is always careful. Development, resilience, partnership, reform. Fine. But in the bilateral meetings, behind the neat phrasing, people will be talking about debt sustainability, development finance reform, and what an energy shock does to already fragile budgets. Because if oil stays elevated, or worse, if Hormuz disruption keeps traders on edge, then a lot of financing assumptions get stress-tested at once. Governments need room to borrow, multilaterals need room to support, and investors want to know which countries can absorb a shock without policy lurches. That's the real pricing question now, not whether a market has potential, but whether it can stay governable under pressure. You can already see that selectivity showing up in very different corners of the continent. Ghana's Damang Mine Award is one example. Mining assets still matter, Resource assets still attract attention, but the route to ownership and control matters just as much as the underlying gold. Investors are reading not only geology, but the rules of the game: licensing, handover processes, legal clarity, state posture. The asset alone is no longer enough. Then look at startup funding in the first quarter. The headline really is not disappearance, it's concentration. Capital is still there, but it is fussier, slower, more demanding. Founders now have to answer harder questions on runway, revenue quality, and market depth. The era of great story, here's a check, was already fading. This energy and rates environment has basically escorted it out of the building. Kenya adds another useful signal with the court-cleared Diageo Asahi ruling. That matters because it tells investors something very simple and very powerful. Transactions can still move through institutions. In uncertain times, a court decision is not just legal housekeeping. It is infrastructure. It tells capital whether disputes can be resolved inside a system rather than through improvisation. So put these pieces together. Morocco gets rewarded for stability and execution. Ghana's mining story reminds us that asset value depends on institutional confidence. Startup funding in Q1 says venture investors are narrowing their bets, not packing up. And Kenya's Diageo Asahi outcome suggests that legal clarity still carries weight. Different sectors, same message. Money has not vanished. Money has become choosy. And honestly, that's the part I keep coming back to. We often talk about Africa as if capital is making one continental decision. It isn't. It is making dozens of highly specific decisions about energy exposure, legal predictability, debt risk, political steadiness, and access to markets. That's a very different lens. So maybe the next investment cycle is not going to be defined by continent-wide averages at all. Maybe it's defined by a much harsher split between the markets investors see as bankable and stable and everybody else trying to prove they belong in the same sentence. And if capital keeps concentrating that way, the real divergence may not be between Africa and the world, but within Africa itself.